and welcome to Intro to Options with DAS. This is a level 2 course describing long calls and long puts. If you've never traded options before, this class will be perfect for you. This is a level 2 course. It corresponds with the brokerage levels that you need for options approval. Of course, this would not be a financial seminar if we did not have our standard disclaimer. And of course, trading and investing is not suitable for everyone. You need to trade with discretionary capital, especially options are higher than normal risk because they involve 2 additional criteria, which is price of the underlying and time. Also something called time decay, which we're going to talk about a little bit today. All the examples shown here are for educational purposes, and certainly you should pursue and get a good education before you start trading live. My name is J DiGioia. I have been a professional trader since 1998, and I started on a trading desk in 1999. And I've had pretty much every experience that you can have on, as a professional trader, as an individual trader, risk manager, market maker, trading desk manager, and of course, I've been a portfolio manager for stocks, options, FX, as well as crypto. And I'm going to be sharing some of these techniques that I've learned on various trading desks with you. Today, we're going to be talking specifically about options. And enough about me. Let's get right into the material. Very, very important, just in general, that the last class, if you joined us for Intro to Options Level 1, that was about covered calls and long protective puts. I'd say the most important thing about covered calls is it's a great income generating strategy. Long protective puts are kind of like insurance on your stock positions. Now we're getting into using options to speculate, and we're going to be talking about long calls and long puts. And obviously, when you're speculating, you're trying to utilize as little capital as you possibly can to get the biggest rate of return that you possibly can. And that's what our focus is going to be today. In an upcoming class, we're going to be doing credit and debit spreads, which also includes diagonals, etc. And then, of course, finally, the last class, which would be level 4, which is uncovered or naked writing. So on that note, we'll get right into today's material. So we're talking about buying calls, okay? Now, the first thing you got to ask yourself when you're looking to buy a call is the stock optionable? Does the option market have enough liquidity? Is it useful enough for you to get into and out of that option easily? Some stocks do not have a very, very liquid options market, so you have to be really, really aware of that when you're considering to trade those. The next thing you got to ask yourself is, are you bullish or are you bearish? If you're bullish, you want to consider a call. If you're bearish, you want to consider a put if you're going to be buying options. Now, I do want to also warn you that sometimes they call options when you're buying calls and puts the poor man's stock market. And that's because you can control a lot of stock. It's basically a 10-to-1 ratio between stock and options. So one options contract represents 100 shares. And that basically is a built-in 10-to-1 leverage. So a lot of times people who get involved in options are doing it because they can't buy a lot of stock. They want to get a big bang for their buck. And I want you to just realize that if you're going to be speculating with options, do so with discretionary capital. And you should have a good knowledge of the underlying. So in trading options, you really need to know a lot about trading stocks. And what stage is the stock in? Is the stock in a consolidation where it's going to break out either to the upside or the downside? Is it in a volatile market where the premiums are going to be higher? So if you don't know technical analysis, I really recommend that you learn more about technical analysis and reading charts, because then you know what stock stage the stock is in, so it can kind of help you gauge your option strategy. Next, stock pattern. Okay, what's the risk-reward ratio on the play? And you should always know what you're risking and what you could potentially gain if it all works out to satisfy your entry criteria. Is it a day trade? Is it a swing trade? Is it a core trade? Now, generally, personally, I don't day trade options. I swing trade options or I core trade options. I like, and there's a number of reasons why I prefer to swing or core trade options. If I'm going to day trade, I'll probably trade the stock because I have a lot of control in the underlying stock position if I'm day trading. So if I'm swing trading, I'm usually looking for a 3 to 5 day swing. So I'm probably not going to trade the front month, the front week. I'm not going to trade that week's expiration if I'm swing trading. I'm probably going to go 2 weeks out or a week and a half out. If I'm core trading, I'm probably going to trade the monthlies. And those are the monthly options, not the weekly options. The next question is, how much money do you have to risk on that particular trade? The good thing about options is that you can really control your risk. What you put into buying calls or buying puts is what you can lose. So the entire thing is at risk. So if you're willing to risk $500 on a play, you put $500 into a play. If you're willing to risk $300 on a play, you put $300 into the play. Consider the entire thing at risk. It's when stocks move quickly, the options price will even move more quickly if it's close to the strike. And if it's out of the money, it'll rapidly lose value. And if it's close to expiration, the time decay increases very, very quickly. The next question is, how much do you have to risk on the trade? Next question after that is, how much time is needed? Okay? How many days to the front month expiration or the front week expiration? So if you're buying it on Monday and it expires on Friday, you got 5 full days if you're buying Monday morning. If you're buying it on Friday, you're going to have time decay over the weekend. And time decay is really, really important when buying calls and buying puts. So how many days to the front month or front week expiration? What strike price will generate the best return on investment, ROI, based on the expected stock move and the stock's risk profile, how volatile the stock is? What is my target and stop price on both the stock and on the option? Now, even though I said you can put the entire amount of money that you put into the option at risk, you can use some risk percentages. So you can say, I'm going to trade the option away if it goes 50% against me. So let's just say I bought a $5 call on XYZ company. And when that $5 call is reduced to $2.50, I trade it away. I've lost 50% on the option, and I'm managing my risk because I don't want to take and lose the entire $500 that I put into the entire play. I'm only going to risk $250. That is a reasonable and rational way to kind of manage your options, either 33% or 50% of the overall value of your position. You can use that as a stop to trade the position away. And make sure that the spread on the particular option is not excessive. Sometimes there's a big spread in some of the options that you'll be trading. So just wanted to introduce some concepts to you, which is return on investment, risk-reward ratio, how much time is needed for the play, what expiration am I trading, what is the time frame that I'm looking for it to move in, what is the stage that the underlying stock is in where I'm looking to play either long or short, in which case long, I'm going to be buying calls. If I'm playing shorts, I'm going to be buying puts. All right, so let's just quickly do an overview on buying calls. A long call option gives you the right, not the obligation, to buy 100 shares of a given stock at the agreed upon price, strike price, by a specific date, the expiration date, for the agreed upon price called the premium, speculating that the stock will rise, major or minor stage 2 on any time frame. So basically a major or minor stage 2 is a chart pattern that if you're interested in learning more about, you can certainly go to the learningdaytrading.com site, which we're going to have a link to that and list that in the description as well. That you can click on that and you can register with me for some mentoring, and I can teach you a little bit about technical analysis as far as stock trading goes, trading the underlying stock and reading the charts. But certainly timing your entry with the option, it's very important to know where the underlying stock is. So a lot of times we suggest that you learn a lot about technical analysis for the underlying stock And then you certainly start to apply that technical analysis using your option strategies as well. So with that being said, let's go through some options terms. So an options contract is the trading unit of options. So each option is a contract, and it's a zero-sum game between the buyer and the seller of the contract. Unlike stocks in which they trade in shares, option contracts control 100 shares of the stock, with some exceptions. And the some exceptions are the very, very high-priced stocks like Google, Amazon, Apple. Many of these stocks trade in also smaller increments, where you can trade the smaller increments of options, but not every stock trades with smaller increments than 100 share options. There's a kind of like a mini options contract for some stocks. The expiry or expiration date is the last day in which the option can be executed or exercised. Technically, stock options expire on Saturday. So if you do have a broker like E-Trade or Thinkorswim, sometimes you'll get an expiry notification on a Saturday. But the last trading day is the third Friday for the monthly options, but every Friday is an expiry for weekly options. Friday is the last day that the option can be traded or exercised. The strike price is the predetermined price that the stock will be delivered at in the event that the option is exercised. And that's just, there's good options terminology and some options lingo for you to kind of know, understand, digest, and kind of get familiar with. All right, choosing your strike. So there's really 3 different options as far as strikes go. I like saying options in different terms, but certainly we have the at-the-money options. I like that because it's ATM. Options that have a strike price at or near the current stock price. We have the in-the-money options that have intrinsic value. For call options, in-the-money options have a strike price below the current price of the stock. For put options, the in-the-money options have a strike price that is above the current price of the stock. Out-of-the-money options have no intrinsic value. They're just purely time value. The value of the option is just the time value. For call options, out-of-the-money options have a strike price that is above the current price of the stock. For put options, out-of-the-money options have a strike price that is below the current price of the stock. Note, the strike that you select depends on your risk tolerance, how bullish and bearish you are. So when I'm writing covered calls, I like to write covered calls because I'm buying the stock that I'm already liking, right? I like the stock, so I want to only write covered calls in stocks that I'd want to own. So usually I'm writing out of the money options for covered calls, right? So that's the buy right that we covered in the level 1 class. If you don't know what a covered call is, go back and watch our level 1 class on writing covered calls and protected puts. But if you're buying a stock and you want to collect, you're writing out of the money, unless the stock goes up, in which case you're making money on the underlying stock. You're going to make money on the underlying stock, and unless it goes past your strike price, you're going to collect on the covered call as well. And if it does pass your entry price on the your strike price on the option, there's a couple of things that you can do to kind of benefit from the movement in your direction as well. So when dealing with covered calls, which we covered in level 1, you usually want to choose out of the money options. In some instances, you'd want to go in the money if you think that the stock is going to go down temporarily. But of course, you're risking the chance that the stock might get called away. Now, if you're speculating on options, whether you choose out of the money, in the money, or at the money is going to depend on how much bang for the buck you want to get. If the stock is in the money, okay, it's going to almost move like the underlying stock. If you're buying in the money, the stock is going to trade, the option is going to trade very much like the stock. It's going to gain 80 or 90% value for each dollar that the underlying stock moves. So in the money options are going to trade almost like a stock. At the money is going to be a little bit cheaper, but if it goes down, it's going to rapidly lose value, okay? If it goes up, you're going to make most of the value with the stock because the at the money option will become in the money if it continues to go your way. If the at the money option goes out of the money, it will completely lose all of its intrinsic value, And of course, it'll only have time value remaining, and then it's going to depend on what expiry you chose. Okay, out of the money is good if you expect a big move, a volatile big move, in which case you would buy out of the money options, because that's going to give you the biggest ROI, return on investment, if it goes at the money and then in the money. As it goes in the money, it's going to go from having just time value to intrinsic value, and then it's just going to rapidly trade just like the stock as it gets further and further in the money. So which one you choose depends on how fast and how much money you have, right? So let's say you only have $500 in your account and you expect a big move, then out of the money would be the best one for you to choose, unless if you feel very confident in the play. If you aren't confident in the play and you think it's just trading like a stock and you're day trading, you might want to use in the money and buy less, because now it's going to trade dollar for dollar. It's not going to be dollar for dollar, but it's going to be 80 or 90% of the movement of the stock. But you're not going to lose too much when it goes down, because it's just going to lose very similarly 80, 90% of the value if the price goes down. So if you're day trading options, you're probably better off day trading in the money options. There are some times where you might want to day trade the out of the money, especially if you're shorting going into expiration and playing time value, things of that nature, which are much more complicated and sophisticated, which we're going to cover in the level 4 class. But certainly what strike you choose depends on how much capital you have, the expected time frame of your move, and where you think the option and the stock is going. On that note, let's talk a little bit about buying puts, right? So a long put option gives you the right, not the obligation, to sell 100 shares of the stock at the agreed upon price, the strike price, on a specific date, the expiration date, for an agreed upon premium, speculating or hedging depending on falling stock prices. Speculating is that the stock will fall. So if the market is in a major stage 4 or a minor stage 4, it's a time frame when people are selling and they're more afraid. Fear is in control of the market. And I'll go back for 1 second, just to give you a little insight into what stage 1 and stage 2 is. Generally speaking, you're buying calls in a major or minor stage 2, which is when the market is being controlled by greed. So in a market that's being controlled by the emotion, greed, and everybody is buying stocks and buying pullbacks and breakouts, you want to be more inclined to buy calls. If you're selling calls or buying puts, which both would be bearish strategies, you're going to do that more likely in a minor or major stage 4. And I can certainly teach you about technical analysis at another time in an individual mentoring session. So on that note, we've covered a lot today. We've covered buying calls. We've covered all the different variations of choosing your strike at the money, in the money, out of the money. And of course, now we're talking about a long put as a way to take advantage of downside. Now, where do puts come in and really serve a very big value? Very often, you can't short stocks. If you don't get a locate, you can't short the stock. So you can very often buy a put, okay? And that allows you to basically effectively be short the stock and make money on the downside. Now, the other time that you might want to buy a put is if you already own the stock and you just want to protect whatever gain you had. So you're up $3,600 in Amazon and you want to protect against Amazon going down and you want to stay in your Amazon position. So if Amazon goes down, you're still going to be long Amazon and you won't be up that $3,600 anymore, but you might make $3,500 on your Amazon put position. So you're not going to make any more money, but you're going to gain $3,500 so that when Amazon starts going up again, you're recouping the $3,600 gain in Amazon and you still got the $3,500 that you made on the put. Does everybody understand how that works? It's kind of a protection by making money somewhere else. And that's called hedging. All right. So let's talk about some exit scenarios for the option buyer. Okay. So the buyer of an option has 3 option exit strategies. And exit strategy number one is to just, you buy the option, you sell the option. So you sell at the money, in the money, or out of the money back before expiration. So let's say you bought out of the money and it becomes in the money, in which case you bought the option at $2 and you're selling it at $5. You just made $3. So profit and loss is profit minus loss, right? Sale price, okay, your sale price minus cost. So if you bought it at $3, well, you bought it at $5 and you bought it for $3. So you sold it at $5. You bought it for $3. That's your profit, $2. Exercise. So the other thing you can do is if you bought the stock bought the option out of the money, and now it's become in the money, you can hold that option to the expiration. You could also exercise the option at any point if you want to convert the option from an options contract into stock, in which case you need to have the cash available to buy the stock. So basically all you're doing in this case is profit or loss equals the current stock price minus the strike price minus the premium paid. That's the same on whether it's a call or a put, okay? And that basically is converting your option into the stock. Okay, the last thing you can do is if the option is going to expire worthless, it's out of the money. Let's say you bought it out of the money, it never went in the money, you never traded it away, and you're just going to let it expire worthless, and you're just going to lose the money that you paid for it, and the loss equals the premium paid. So those are your three scenarios, and you're going to see that's for the buyer of options. Now let's just go for the three exit scenarios for the seller of an option. Now this is the counterparty, because level 2 options trading only allows for you to buy and sell, buy and sell, buy and sell. Okay, the seller of an option has 3 exit scenarios. Okay, buy back, they buy to cover at the money, in the money, out of the money before expiry. Sales price to open, buy to close. Okay, and that's where that buy to close button comes. We showed you the Dash Trader software in level 1, and that's where it says buy to close. You buy to close. You sold to open, so now you're buying to close. Exercise. Okay, so let the in the money option be exercised against you. A call must sell the stock at the strike price. So if you're selling the stock at the strike price, you're going to be short. Okay, if you're not covered. Or you're going to deliver the stock to the person who that you wrote the option to. The put must buy the stock at the strike price. So it's just the opposite relationship. So the obligation is the opposite of one another, whether it's a call or a put. Do nothing is let the out of the money expire worthless and keep the premium received. You just collect the money, you keep the money, and that's just it. And that's the beauty of writing covered calls. You own the stock, you write the option against the position, and you just keep receiving money on the underlying stock. And that's the beautiful thing about this, is that you can do this in your IRA and your qualified plan. And it's a great way for you to earn money on stocks that you're just keeping in your retirement portfolio. All right. Well, I hope you found today's session interesting and informative, and I hope you decide to join me in one of Dash Trader's new mentoring offerings and opportunities. You can find out more about this and certainly sign up if you'd like to work with me on an individual basis to amp up your trading using options, or just use options for income generation strategies. Go to learningdaytrading.com, scroll down to individual trading, coaching, and mentoring, and then click on the DAS mentor button. That's DAS mentor button. Click right there, and that'll bring you to a sign up page where you can sign up with me. I have a couple of specials going on right now. One being a special for 30 minutes, as well as we do a 30-minute Zoom session. And then from there, you can buy some larger packages for 5 and 10 hours. And certainly some discounts apply there as well to kick off this program. I hope to see you in upcoming classes. Certainly you can message me, email me if you have any questions, if you'd like me to cover any future topics. Look forward to working with you, and I hope you found today's session very informative. All the best.